Hello there. I hope that you're doing well. Welcome to the first lecture of the day trading model. This lecture is going to be about order flow. Before we begin this lecture, I want to share a few key notes with regards to this series. The first note is the following. During this series, I will guide you to a higher level of understanding price delivery. This does not mean that you will reach profitability after watching this series straight away. The reason why I can't promise you to become profitable is the following. You are an individual who has its own struggles. You might be given rules, but for some reason you are not disciplined enough to stick to those rules. You will bring a lot of mental struggles to this trading. And that's what makes it so hard. And we will have psychological lectures as well. So I will share with you insights how to overcome the majority of certain psychological struggles because I've been through them as well. Anyone that says that this can be easy, that it's easy to understand how these markets work and it's easy to make financial decisions based on them, is absolutely lying and you should run away when someone says that. Secondly, it's important to note that from the release of this lecture, every single week a new lecture will be finished until announced that the series is complete. And from there on, future add-ons will be added, but not every single week. And finally, I want to share with you the following. It's important to take proper notes from day one. So that means during this lecture, if you hear me say something that you believe to be valuable, you should write that down and then come back at a later point in time and restudy it. Because the greatest light bulb moments don't necessarily come whilst watching or studying new educational content. As weird as it may seem, the greatest light bulb moments that one can experience actually occur just while doing regular daily stuff. Maybe whilst going for a walk and you're thinking about that new concept that you've learned, and out of nowhere it clicks. Ah, that's why it works. And that's what I hope that you will achieve after watching this first lecture and the lectures that will come. Because that light bulb moment is the most beautiful thing that you can experience. And every single light bulb moment should be journaled and cherished. So, enough of the rant, let's begin with the order flow lecture. Before we begin, I must give you a risk disclaimer. I am not a financial advisor and I will not give you any financial advice during this series. All I will share with you is my understanding of price delivery and my view on the markets. This is meant for educational and or entertainment purposes only. If you want to read the full risk disclaimer and the terms of services that you have agreed upon when joining the mentorship, you can do so by going to our website, theonesthatknow.com, and then scroll through these files. This model is ideal for the personality that is interested in getting in and out of the market within a relatively short period of time due to a variety of reasons. The reasons that could be present for a person to be interested in day trading over swing trading can be the following. He or she does not want to be attached to the charts all day. And you might think, huh? Are Isn't it true that swing traders aren't only not attached to the charts all day? No. Reason why is because the model that will be shared with you is very time specific. So that means there are intervals during which we will look at the charts. We will not look at the charts outside of those intervals. And you might wonder, why would we do that? Because during very specific time intervals, the market delivers in a certain manner. So if we know that, our job is to show up during the right times. Because it's time that comes first and then price. It's not, okay, the price pattern is present and it doesn't really matter what time it is. It's London lunch, it's 5 a.m. in the morning, but you know what? I see a bearish breaker, so therefore I can trade it. No. You will be given very specific times to look for very specific algorithmic signatures within the delivery of price. And that's the goal of this model. And finally, this model is ideal for the personality that has a short attention span, meaning that he or she has not the ability to focus for long periods of time and therefore has to be very objective about during what times he or she will utilize their focus. So it means during what hours they will really focus and be present and only think about the charts. Before you watch this lecture, it's important that you have watched the foundation lecture, which has been uploaded on the 15th of December 2023 on the mentorship platform, and that you watch the beginning of the IPDAT journey, which was uploaded on the 30th of December 2023. The reason why I want you to watch these lectures before beginning this model series is the following. I will not treat you like a complete beginner. I will be talking to someone who has already built up some understanding of how to look at price delivery from an algorithmic perspective. And the reason why I want to do that is because I do not want to make it too uncomfortable for the more experienced traders to look at these lectures. And I know that you might think, for as a complete beginner, why aren't you then sharing it again, the knowledge? Well, because the knowledge has already been shared within these lectures. And just so you know, what I'm referring to is just a simple understanding of imbalances, a simple understanding of breakers, a simple understanding of just in general PD arrays, just sell side liquidity, buy side liquidity. I would not share that again within this series because I believe that you should already know this before you watch this series. So let's now really dive into this lecture. Before we can determine order flow, we need to know by what order flow gets measured. We will not be using any depth of market, volume profile, or whatever tool retail-minded traders might use that they believe to give them insights on the markets. All we will use is a blank chart. And on that blank chart, we will only use time and price. Meaning, at very specific times, we will be looking at very specific algorithmic signatures that will show us whether or not these algorithms are right now active within the markets. First of all, you might think, Susie, you just said we're not going to discuss any basic knowledge, and now you're showing us an uptrend. I know, but I'm going somewhere. Just wait. Here we can see an uptrend. An uptrend is basically that higher highs are being made. What we call this is bullish institutional order flow. Means that the market is going higher, retracing, higher, retracing, higher, retracing, higher, retracing, higher, etc. That's bullish institutional order flow. For bullish institutional order flow to occur, there has to be a market maker buy model. A market maker buy model is simply the following schematic. It means that there's a sell side delivery, aka delivery lower into a very specific price level, our point of interest. And from there on, buy side delivery occurs. So the market delivers higher and we see that uptrend occur. It's very important to note that this all has to occur during a TOI, aka a time of interest. If we anticipate higher prices, we will look for the POI to be reached during our time of interest and wait for signatures to confirm the SMR. The reason why this is important to know, because if we want to gauge order flow, we first must know, okay, what are potential key reversal prices where the market could tap into before reversing. And if we know that there's a certain price level that is significant, for example, a higher time frame PD array, and the market trades into that, then we can wait and see, okay, will any reversal signs be present? If not, okay, then the market is going to continue the original order flow. If it does, however, show signs of reversing, then order flow is switching and a change in the state of delivery is occurring. If we take a look at a downtrend, it's the following. Lower lows are being made and lower highs. So if we take a look at this, we see sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery. Alright, so here we can see the market maker sell model schematic very simply put. So what we can see is that there's repricing higher into our point of interest, into that very specific price level, during our time of interest. And if we anticipate lower prices, so if our narrative and higher time frame order flow is signaling to us, okay, well, we're likely to deliver lower for the upcoming period, then we look for that PY to be reached during our time of interest, and then we wait for signatures to confirm the SMR, aka the smart money reversal. And notice that we're not even looking at the different stages of the market maker models just yet. The market goes higher until the point of interest gets reached during our time of interest. Then we see signatures that confirm a reversal occurring, and from there on we see sell side delivery or lower repricing. Alright, so now we're going to take a look at reversal patterns. There are two possible reversal scenarios. The first one is a breaker block formation, and the second one is a mitigation block formation. There are no market reversals unless one of these two occurs. You can go into the charts after you know what they look like, and you will never be able to see a reversal occur without one of these two occurring. It's as simple as that. So let's take a look at the breaker block formation. As you can see, the breaker block formation is the following. We can see that sell side delivery occurs, the market reprices lower, a low gets engineered, the market retraces, creates a high, and that high gets utilized to send price lower once more, purging sell side liquidity, trading into our point of interest, into this price level, and from there on a reversal occurs, market displaces to the upside, and from there on we anticipate this upclose candle to be utilized as support moving forward. You might wonder, why would this occur? Why would we want to see that upclose candle act as support on price? It has to do with balanced price ranges. Balanced price ranges are the following. They are, in my opinion, the most important thing to understand when it comes to understanding the hierarchy of institutional order flow. A balanced price range can be understood when you look at delivery cycles from a seesaw perspective. So that means you start counting how many times each delivery cycle has occurred within a very specific price range. So if we start counting, we can see the following. We can see that sell side delivery occurs here. Inside of that sell side delivery, a CB gets created. The market offers buy side into that CB, and it then offers sell side again, trading away. Into what? Into the sell side liquidity engineered below this low. So it purchases that liquidity by tapping into our point of interest, and it then reverses to the upside. But hey, what occurs here? Buy side delivery gets delivered again. So from there on, if we start counting again, we can see sell side, buy side, sell side, buy side, but there's something missing. Why is there something missing? Because this buy side delivery higher has made the delivery within this price range, within this CB, imbalanced. So what has to occur is the following. The market has to reprice lower over sell side delivery before it is allowed to expand higher. And that's why you will always see a retracement form into a breaker block, and specifically into the imbalanced price range here before it continues to the upside. And it's the same for mitigation blocks. However, one important thing to note is that buy side and sell side delivery doesn't always necessarily mean that it has to first trade away a lot, so it means that candles have to be formed outside of the price range and that it then retraces. That's a possible scenario. However, another possible scenario is the following, in which there's a wick of a candle that reprices above the high of the breaker block. I apologize for not having the box annotated perfectly to the high, but I wanted to show it clearly that this is the high I'm referring to. So the moment that a wick reprices above that high, it's already a confirmed change in state of delivery. And what's possible is that the next candle then completely shoots price higher after opening inside of the breaker block. Why is that allowed to occur? Because if that open occurs and sell side delivery occurs once more in the form of a wick, the market has already delivered efficiently inside of that price range and it's allowed to expand to the upside. So therefore, a breaker block is part of a balanced price range, and your breaker blocks form inside of imbalanced price ranges. So if we take a look at the mitigation block, the mitigation block looks like the following. A mitigation block is when sell side delivery occurs and the sell side delivery trades all the way into our point of interest, into the price level where we're anticipating a reversal to originate from. From there on, a high gets engineered. That high then sends price lower once more, but it does not create a lower low relative to this low, to the low that formed prior to the high. And then price expands to the upside. The up close candle is the mitigation block, and we can apply the same logic to see whether or not this is a balanced price range now when the market has retraced into it and expanded to the upside. We can see the creation of this CB here. Then the market retraces into that CB, into that bearish fair value gap, it forms a high, so it means buy side delivery has occurred, into a price range where only sell side delivery occurred, then sell side delivery occurs, out of it, buy side delivery occurs again, so you might think, oh, but now we have 2 times sell side delivery, 2 times buy side delivery, right? Yeah, but buy side delivery by itself already here has an imbalance inside of it. There's a BC that formed. So that means sell side has to be delivered again before the market is allowed to expand higher. So that is why we can look at this and say, okay, well, a mitigation block is basically a failure swing. There's a failure for the market to create a lower low after the creation of this high. Whilst for the breaker block, a lower low gets created, and that's why we call that a full swing. And one of the important things to note is that when a breaker block forms on one market, we usually see the formation of a mitigation block on a highly correlated market. And that means that one creates a lower low, whilst the other creates a higher low. And that's what we call SMT, Smart Money Tool, or Smart Money Technique. There's not a real name dubbed to it, but what SMT basically signals is that smart money is actively buying this market inside of a bullish scenario. For the bearish thesis, for the bearish breakers, just invert the logic, and the same for the bearish mitigation blocks. So for the bearish mitigation blocks, you would be looking at a high that would form, a low that would form, then a lower high would form relative to that initial high that formed, market displaces to the downside, then that last low is your mitigation block. And for the breaker, it's when a high forms, a low, a higher high forms, displacement below that low. Now that low that formed initially, which sent price higher, is your bearish breaker. So it's just the logic shared here, but then inverted. Alright, so here we are in the real charts. And I'm going to explain to you what I mean with a higher time frame retracement is the left side of the curve, and that the expansion leg on this higher time frame is the right side of the curve within a fractal market maker model. What we can see is the following. We can see that there's an indecisive candle that forms after we have seen multiple candles to the upside, right here. What then occurs is that a high gets created here, and the market then displaces lower or gets repriced lower into the high of this up-close candle here. This is what we call immediate rebalance. I'm going to take you with me to the lower time frames to see how price reacted off that immediate rebalance price level. But after that immediate rebalance occurs, we can see that the next candle immediately targets the buy side engineered above this high. So here we can see the lower time frames. And as you can see, this dotted line is the high of that previous higher time frame candle, aka the immediate rebalance that occurs. What we see is that buy side got engineered above these highs here. This is our original consolidation. Then the sell side of the curve unfolded here into that price level. After that price level was reached, the market then reversed, targeting buy side liquidity. If we go into even a lower time frame, we can see the following. We can see our market maker buy model in here. We can see that there's an original consolidation up here. Then we can see the distribution phases in which every retracement is being sold by smart money. And from there on, we can see that more buy side liquidity gets engineered here. Look at the equal highs that get generated. And the market keeps on displacing lower. Expand, retrace, expand, retrace, expand, retrace, expand, retrace, expand, retrace, until it reaches that very specific price level at 1:22 p.m. And from there on, we can see that the market begins to deliver to the upside. Targeting what? Targeting the high of that candle, of that indecisive candle. And if we take a look at this reversal here, we can see our bullish breaker formation. Where do we see the bullish breaker formation? We see the bullish breaker formation inside of this up-close candle here. And the reason why this up-close candle is important is because this up-close candle formed, or this high formed, after we saw an initial leg lower, a low get engineered, boom, market retraces into what? Into this CB here. From there on, it gets utilized to send price lower once more into our key price level, boom, some time distortion here, don't get fooled by that, begins to displace to the upside or expand to the upside, imbalance forms inside of that breaker, retrace, boom, sends it higher, targeting the buy side liquidity above that high. If we take a look deeper into this chart and we zoom in on the smart money reversal, we can see the following. We can see that I've extended this CB all the way to the right. And you might wonder, why is this high not important to you? Why not this high? Why specifically that high? It's because what I just outlined to you. When a high gets formed inside of an imbalance, the moment that that high gets broken and the moment that that imbalance gets broken or displaced above, if this was a CB, what we then want to see is that we want to see the price range of the CB and that up-close candle get utilized as support going forward, because a change in the state of delivery has been confirmed by then. It already gets confirmed earlier, but if this occurs, it's so sweet. And you will see it so many times in your charts. And I have dubbed this pattern in which there's a CB that gets formed, a high that gets formed in that CB, followed by a displacement leg above that high as the market structure shift pattern. But there's one more thing you need to note, as the following. Within the break of this high and this CB, within the price range that breaks through that high, there has to be an imbalance, there has to be a BC. This doesn't necessarily mean that the BC has to be created above this high, but it just means that in the sequence of candles that breaks through that high, there should be an imbalance that we can utilize to buy from going forward. And that's what we call the market structure shift pattern. So here's the final delivery where again the buy side liquidity above here got showcased. So let's take a look at another chart. As you can see, here we are on another chart. For those of you that are wondering what chart this is the dollar index chart and then the monthly chart. What we see is the following. We can see that the market consolidated here. It purged sell side liquidity below these lows, then reverted higher, or it retraced into this CB here. This is a CB because there's a lack of buy side delivery inside of the price range between this low right here to this high. The market retraces and it then begins to fall over, begins to expand to the downside. What I want you to understand is that by looking at this chart, we can see the following. We can see that buy side delivery occurs here, or a retracement, but within a lower time frame, we will be able to see that that buy side delivery is the left side of the curve within a market maker sell model. This expansion leg lower from that CB is what we call the right side of the curve, or the sell side of the curve within a market maker sell model. And what we see is that if we zoom in onto the weekly chart, we can see that this was the buy side delivery. Boom, market consolidated a bit and it then fell over. What we see is that inside of that sell side delivery, there are multiple retracements that occur. So you have an expansion leg lower, retrace, expansion leg lower, retrace, expansion leg lower. And the reason why I'm sharing this with you is the following. If we think back to what was shared with you, and we understand that a retracement on this time frame is the left side of the curve within a lower time frame or fractal market maker sell model, we already know that if we would zoom in deep enough or low enough on the time frames, note this is a weekly chart, we will see sell models all over the place. So if we know that the order flow on the highest possible time frames has shifted bearishly or has been bearish, then what we can see is that if we go into lower time frames, we can see that from those higher time frame price levels, smart money reversals occur, breaker block and mitigation block formations occur, and from there on reversals occur that gets utilized before price is allowed to expand higher or lower in this case. If we zoom in on that reversal point above here, we can see the following. We can see that a high gets created here, low, higher high. The moment that this low gets broken, it's already a sign of, oh, it's a change in the state of delivery, potentially. Why? Because this low formed inside of this CB. But what do we know then? We see that consolidation takes place. Why? Because it was not the right time yet for the market to reverse. So what then occurs is that within this down close candle, which is a bearish breaker here, there's another bearish breaker that forms inside that consolidation. Because what we see is that a high gets engineered here, a low, and that low gets utilized to then send price higher, taking out the buy side liquidity above here. What then occurs is that displacement occurs below that low, below that down close candle, market has to retrace. Why? Because smart money bought this down close candle and they need to mitigate their losses. So the market gets offered higher, retrace, boom, gets utilized to send price lower. And what I want you to understand again is that within this retracement leg higher, there's a fractal market maker sell model that formed. Buy side of the curve into a price level where we can anticipate a smart money reversal to occur from, followed by the sell side of the curve. The same occurs here, where we see a low form, here, two equal lows, market retraces into the CB, institutional order flow entry drill takes place, boom, price gets sent lower, taking out the sell side liquidity below here. And what I want you to understand is that within a lower time frame, a market maker sell model is present here again. Buy side of the curve, sell side of the curve. It happens in every single market stage. All you need to do is go into low enough time frames and you will see the market maker sell models occur. Simple as that. So let's now take a look at time frame synchronization. Before we can use time frame synchronization to determine the drawing liquidity, we need to first know how to spot institutional order flow. It is crucial that you understand this, because without an understanding of institutional order flow and or narrative, you will get caught up in chasing price patterns for the sake of chasing price patterns. It will make you just a new retail-minded trader. It will just make you a bull flag or whatever animal pattern you might use trader. That doesn't matter. It doesn't matter that the pattern occurs. What matters is that the pattern occurs at a very specific point of interest at the right point in time during a time of interest. That's what matters. So how do we determine order flow and narrative, really? First of all, we can look at the news and the general market sentiment. We know that when markets are going higher and when the news is becoming very bullish, euphoric, so to say, we should be cautious because we know that news gets utilized, or that leg higher gets utilized for smart money to open short positions against, to sell against. So when the news turns bullish and price is near or at premium race being premium breakers, premium mitigation blocks, premium inefficiencies, premium balanced price ranges, premium volume imbalance, etc., premium liquidity pools, we should be warned because we know that they use that news for manipulation purposes. When the news turns bearish and price is near or at discount arrays, we should also be warned. Discount arrays coming in the form of, for example, discount balanced price ranges, discount breakers, discount mitigation blocks, discount imbalances, BCs to be precise. And we know that they utilize that news for manipulation purposes again. So when the markets are dropping, we want to be looking for signs to justify looking for buy signals if the higher time frame order flow is bullish. So let's take a look at the same schematic again, but let's now add another variable to the sequence. The variable that we've now added is the following: news. As we can see, during the sell side of the curve, news gets released. This news gets utilized to send price lower into our point of interest during our time of interest. This news gets utilized for the final repricing lower before the real move is allowed to occur. And that's something that a lot of people seem to not get. Many people that have been trading and they have been investing, they have been active in the stock market, etc., we also ask them the question, what usually happens when positive news comes out? What follows? Well, usually they say the price begins to start dropping. So what happens when bad news comes out? Well, usually the price begins to start rising after a period of time. So that means that initially there can be, if the news is bearish, a leg lower. But that leg lower follows that higher time frame order flow into that price level that we've been waiting for. And from there on, a buy program unfolds, sending price higher. And it's funny to realize that because then it makes sense how the whole smart money paradigm sets you free from all retail minded traders, their beliefs, because they look after the fact why something has happened. We look on the right side of the charts, that blank area that no one has ever seen or touched. That's our goal as smart money minded traders. If we take a look at the market maker sell model schematic that I've been utilizing with you so far, we can see that there's a leg higher, and near the end of that leg, near the reaching of our point of interest, news gets released during a time of interest that sends price higher into that price level that we've been anticipating and waiting for. And from there on, a sell program begins and price is distributed lower. So again, the function of the news was to send price higher. Once more, trap retail-minded buyers into believing that the markets were going to continue to rise. Boom, lower time frame, break or mitigation block formation during the right time, and there it goes. Smart money reversal confirmed. And here's an example of that. As we can see, this is an article of Reuters, however you pronounce it. And what we can see that on the September 20th, 2023, they wrote an article saying the dollar index on the verge of forming a bullish golden cross. The Bank of America says. So the Bank of America is a pretty substantial bank within America, and they said that the dollar index was likely to form a very bullish retail-minded pattern, so to say. If we take a look at the dollar chart in a bit and see when this news article was released relative to where dollar was at, and we look at it from the perspective that I'm teaching you to look at the markets from, a light bulb moment should go off. At September 20th, that article came out from Reuters. It was inside of this candle here on this day that article came out. Notice that afterwards there were only about 10 candles that were still inside of an uptrend. And from there on, a monthly CB gets reached, that CB that we discussed. And from there on, the sell side of the curve unfolds. And what I'm trying to prove to you here is the following. The moment that, so to say, legitimate sources or reliable sources or governments come out and they say something that is against our higher time frame idea of what should occur, it's the best confirmation tool that we can utilize because we know that they manipulate these markets and they utilize the news for repricing purposes. So therefore, I suggest you to just go into your own charts and see when certain things were said and what was followed. Because if we think about what occurred in 2020 when the C virus came out, I'm not going to say it out loud because then this mentorship platform might be shadow banned or something like that. I'm not too worried, to be fair, because it's our own platform, etc. We're not depending on any sources, but still I'm being careful with saying that because we know how it goes on the internet nowadays. Because that C-virus came out, we saw the markets drop for a few months. There was panic. People were like, huh, what's happening? And blah, 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 all of that stuff. However, what followed was one of the most explosive bull markets or higher repricing events that occurred in the past decades. So what we can take away from that again is that the news gets utilized for repricing purposes, and therefore we can anticipate news as well to come by simply looking at the charts. What happens is already priced in, and the news comes after the fact. And I'll let you think about what that really means about how controlled and engineered this world really is. Secondly, to spot institutional order flow, we will be looking at the relationship of the PD arrays that get created and act as support or resistance, or fail to do so. Within bullish order flow, our eye is drawn to a blue shaded box here on the left side of the curve, on the sell side of the curve. Inside of that blue shaded box are inefficiencies, CBs to be precise. The market reprices into our point of interest, into our price level during our time of interest. Boom, market expands to the upside. And because these CBs are failing to act as resistance on price, meaning the market doesn't retrace into that CB and then continues lower, because it fails to occur because those CBs fail to act as resistance on price, it's a sign to us that a change in the state of delivery is occurring or has occurred. Because if we take a look at, or if we think back to the example that was shared prior with you with regards to the market make and buy model on Nasdaq, and we think back to that CB that got created, then a high formed inside of that CB, market was sent lower. After reaching our point of interest, the market traded above that CB, and now that CB began to act as support on price moving forward. The reason why that's important to note is because if the market would be bearish, that CB would not get broken, it would not get violated. So if it does get broken, as we can see occur, then we can say, okay, now buy side is likely to be the draw next. But only if our point of interest has been reached during a time of interest and we see the confirmation signs that we will be looking for. And here's another example. What we can see is that there's a CB on the left side of the curve that got created here. A high formed inside of that CB. This is that same price example again, by the way, but annotated it a bit differently. What we see is that that high gets created inside of that CB, price gets sent lower afterwards, purging the low that was utilized to even create the high in the first place. Then the market reverts, and from there on, a buy program begins. But what confirms the buy program? Well, if we take a look at this price action and we see this CB, this is the most significant CB inside of the final leg lower to my eye because this high formed inside of it. So the moment that price breaks above that high, I want to see the candle of that high be utilized as support moving forward. And the fact that price broke above this CB signals to me, okay, there's a willingness for the market to now move higher. And if we take a look at all of the CBs that followed afterwards, or I mean the CBs that got broken afterwards, we can see a CB here. Fails to act as resistance on price. Price breaks through it, boom, begins to act as support on price. Next CB, up here, price breaks through it. Here, boom, CB begins to act as support on price. Next CB, here, price spends a bit of time in it, but eventually breaks through it. And then that CB begins to act as support on price. So what I'm showcasing to you is that we need to look at the left side of the curve in order to determine how the right side of the curve is likely to deliver. I will go more on depth in this later because we will specifically look at the left side of the curve to also justify entries and trade management. However, for now it's important to note that the moment that the imbalances on the left side of the curve begin to fail to act as resistance on price, we need to be warned and we need to anticipate higher prices to occur next. So if we're taking a look at bearish order flow or the market maker sell model, our eye is drawn to BCs that form inside that final leg higher, targeting our price level or point of interest. The moment that those imbalances get broken, get violated, we will be looking for a change in the state of delivery to have occurred, and therefore sell side delivery is likely to be next. Because if the market was going to continue higher, it would retrace into those BCs and then continue higher. Here we are again on the dollar chart, and what I've done is that I've annotated all the BCs and extended them to the right. All the BCs that are significant to my eye and that are easily spotted by you. What we can see is that the highest BC here got broken through, and notice that all the bodies closed inside that price range. There were a few wicks above it, but the wicks do the damage and the bodies tell the story. What we then see is that this BC is also relevant. Why this BC specifically is because we can see that a real significant low formed inside of that. Same can be said about this BC here. Next BC is here. And notice how price is first finding support in or at those BCs, retrace, boom, gets broken. This BC again, market trades into it but completely overshoots it. Market trades into a lower BC as well. This is where short-term low gets created. Market retraces. Look at the bodies closing below 50% of that inverted fair value gap. Boom, sends lower. And the reason why I'm showcasing this to you is because of the following. I want you to see how price is moving through those imbalances on the left side of the curve and how it's referring to those imbalances on the right side of the curve. This is what we mean when we say that the left side of the curve influences the right side of the curve. And this is how we can gauge institutional order flow. So we have come to the end of the order flow lecture. I want to give you some homework. I want you to go into your own charts and study all of the times price reached a POI that you deemed to be relevant and PD rays began to fail to act as resistance or support on price. If you are looking at market maker buy models, your eye should be drawn to the CBs on the left side of the curve to see whether or not they're acting as resistance on price going forward. If you're studying market maker sell models, your eye should be drawn to the BCs that form inside of the left side of the curve and their unwillingness to be utilized as support before being sent higher. You should study at what time or what time interval this reversal period occurs, in which the imbalances begin to fail to act as support or resistance on price and the market begins to show signs of reversing. I want you to collect at least 30 plus charts that have been annotated in depth before watching the next lecture of the model series. The next lecture will be about point of interests. We will create this mechanical rule-based model step by step. I want to thank you for watching this lecture. Be safe, and I look forward to welcoming you within the next one soon. Welcome to the second lecture of the model series. During this lecture, we're going to discuss points of interest. Before I'm going to begin with this lecture, I must advise you to first watch the first lecture if you didn't yet. Next to that, you should have done the homework before watching this lecture. The reason why I want you to do those things is because you're else going to do yourself a disservice by already taking a look at this lecture. I know it may sound stupid or it may sound weird, but that's just the way effective learning gets done. You follow the structure that gets provided. You don't just jump from this to this to this. No, you follow the structure that gets provided, and then eventually you will notice that the growth takes place by following that structure. So that's why I'm advising you to do those things. Before we begin with this lecture, I'm going to first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and/or entertainment purposes only. If you want to read the full risk disclaimer and terms of services that you agreed upon when signing up, you can do so by going to the website that can be seen within the webpage. Next to that, you can go to theonesthatknow.com/terms of service and you will be able to find all of the details. So let us take a look at the schematic that was shared with you initially during the last lecture. In this schematic, we can see bullish order flow, aka a market maker buy model. We can see the sell side of the curve right here. Sell side delivery occurs into a point of interest during a time of interest, and from there on a smart money reversal occurs and the market reverses and goes higher, targeting buy side liquidity. If we anticipate higher prices, we look for the POI, the point of interest, to be reached during our TOI or time of interest, and we wait for signatures to confirm the smart money reversal. During this lecture, we're going to focus on what this blue line is and on what this point of interest is. So here's the bearish order flow example, the market maker sell model. As you can see, repricing higher occurs, buy side delivery into our point of interest during our time of interest. Boom, market reverses and it delivers lower, offering sell side delivery. Again, we're going to focus on what this blue line specifically is during this lecture. So first of all, we're going to start with something very basic. But it is important that you understand this. So take notes. Higher time frame PD array as a POI, or that means that we will utilize a PD array on a higher time frame as a point of interest. So what this could mean is the following. We could utilize higher time frame balanced price ranges, breaker blocks, mitigation blocks, and imbalances as point of interest on the lower time frames to see whether or not market maker models can unfold from them. If we take a look at a few schematics that I've created for you, I want you to do the following. I want you to take a screenshot of each schematic. I'm sorry if the watermark is on it when you're going through the video initially. Just wait because it will eventually move and then just take a better screenshot. I want you to save those screenshots somewhere and I want you to utilize them when you go into your own charts to investigate to see whether or not there's any validity behind what I'm saying. So here we can see the first schematic. As you can see, this is the schematic in which there's a CB on the left side of the curve right here that gets extended to the right. Market taps into that, boom, expands higher. That's what it looks like on a higher time frame. But what I will share with you today will open up your eyes when it comes to knowing when and where market maker models unfold on the lower time frames, because every single move has a market maker model in it. It's as simple as that. You will never find a market move that does not have a market model in it, and that shows the beauty of them. So if we zoom in on this delivery right here, on this down close candle, and the candle next to it, you can see that equal highs get created here. Market then opens with this candle, it trades lower. What do you think this looks like on the lower time frames? That delivery lower is the sell side of the curve within a lower time frame market maker buy model. Here we then see that the POI, the point of interest, this old CB gets reached, this blue line. Smart money reversal takes place, and then this big up close candle occurs, which is the buy side of the curve. And that's how you can see whether or not market maker models unfold in one another. It's the fractality of the markets explained. If we take a look at the next example, we can see the breaker block example. For the breaker block, we can see that a low gets engineered after sell side delivery occurs. Here, market retraces into what? Into this CB, creates a high. That high gets utilized to send price lower once more, purging the sell side liquidity below this low. It displaces to the upside. Boom, it retraces into the breaker block, finds support there, continues higher. That's what it looks like on a higher time frame. But if we zoom in again on this delivery, on the delivery that has been annotated, we can see that equal highs closely got engineered right here between this indecisive candle and this down close candle. This down close candle delivers sell side into the breaker block. So that is the left side of the curve within that buy model. Then the market reaches that red line, that high of that breaker block. That's where your smart money reversal occurs, and that's where the low of this candle forms. And from there on, buy side delivery occurs, and the buy side of the curve gets delivered. So we have seen a few examples so far, and I'm going to keep on showing you examples until you understand this. A higher time frame retracement followed by an expansion is a lower time frame market maker model. I'm going to repeat that for you. A higher time frame retracement followed by an expansion is a lower time frame market maker model. If we take a look at the following example, we can see that there's a mitigation block. A mitigation block because there's sell side delivery. A low gets created here, market retraces, it forms a high, but doesn't create a lower low. Instead, a higher low gets created. Market expands above the high, it displaces, and from there on, you can see that a retracement occurs into that candle's high, and from there on, you can see that the market aggressively expands higher. If we zoom in again on this delivery right here, we can see that equal highs get engineered right here. That's our original consolidation. If you didn't notice that yet, then this downcast candle is the sell side of the curve within our market maker buy model. So our sell side of the curve in the following, we can see that market expands away from the original consolidation. It retraces here, first stage of distribution or a low sell, second stage of distribution, and finally a third stage of distribution or redistribution. Then the market expands aggressively into the mitigation box high, which is annotated by this fat red line. Smart money reversal occurs right here, and boom, buy side delivery occurs, targeting the original consolidation and beyond. Now, imagine the following. Imagine knowing that you're in a higher time frame buy program. So that means on the highest possible time frame, the markets are bullish. And you go into a bit of a lower time frame. For example, let's say that you're bullish on the daily time frame and you go into the hourly time frame. Let's imagine that on the hourly time frame, you see this scenario play out or unfold, in which there is a mitigation block creation, market retraces into that during the right time of day. You see a low form, boom. How sweet is that? How sweet is it when all time frames align? How sweet is it that when you're bullish from the most highest possible time frame, And you can see that bullish bias work on the lower time frames as well, because it's all connected with one another. Without these lower time frames fluctuations, that higher time frame bullish scenario, that bullish bias, will never play out. But if you know that in order for a higher time frame bullish scenario to play out, lower time frame market maker models will form, you seriously have such a big advantage. Because then it's not random anymore why the market goes up or why it retraces and then aggressively goes up again. Because you know that on the higher time frame it's drawing to a specific price level, it's drawing to a key liquidity pool or a key PD array slash imbalance. Alright, so let's take a look at another example. Here we can see a sell side delivery lower, low gets engineered, retrace, form a high. This high is your bullish breaker, but we're not paying attention to the bullish breaker now. Sell side delivery occurs again, purging the sell side liquidity below here. Market displaces above this high. It retraces into what? Into this BC, into this bullish fair value gap, and that's our PY for this scenario. So we have this bullish fair value gap on our chart. Then we see that there's relatively equal highs that got created here, or a trend line that can be drawn from this high to this high. Retail thinks, okay, a high is in, we're now gonna go lower. This is our original consolidation, sell side of the curve into what? Into that very specific price range that we're anticipating for an SMR to form in. Market reaches that bullish fair value gap, forms a low, displays to the upside, boom, there it goes. Targeting buy side liquidity above these highs right here, which is our original consolidation on a lower time frame. So let's take a look at the same scenario, but now without the whole bullish breaker stuff added to it. This is purely a BC that got formed. And this is a scenario that you will notice unfolds in very bullish markets in which there's a lot of speed and velocity behind the markets, so it's in a rush to get somewhere. What you will notice then is that there are a series of consecutive up-close candles, and between those consecutive up-close candles, there will be the creation of a BC. And if the market did not reach the high time frame objective yet, that BC will be utilized to send price higher. So the market will retrace into that over sell side of the curve on the lower time frame market maker buy model, reach that BC, and then from there on continue higher, targeting buy side liquidity and drawing towards that higher time frame objective. So let's take a look at the bearish examples. Here we're taking a look at the bearish examples, and as you can see, we're going to begin with the bearish breaker block. We can see that buy side delivery occurs right here. A high gets engineered, market forms a low inside of a BC. It then expands higher, purging the buy side liquidity before displacing below that low right there. This low then becomes your bearish breaker. So we're going to take a look at the delivery inside of here. The delivery that forms inside of this down close candle, inside of this up close candle, and inside of the next down close candle looks like the following on a lower time frame. We see an original consolidation, which gets formed here. Then the buy side of the curve unfolds into our bearish breaker price level or into the bearish breaker low. And on a lower time frame, we will see that a smart money reversal unfolds inside that bearish breaker, and from there on we see the sell side delivery of the curve occur into the sell side liquidity engineered below the first candle that broke below the bearish breaker and lower eventually. So let's take a look at the bearish mitigation block. As you can see, the bearish mitigation block comes in the form of the following. We can see buy side delivery, a high gets formed, market creates a low inside of this BC, but it fails to create a higher high in the run afterwards. Instead, it makes a lower low. It then displaces below the mitigation block. We're going to focus on this delivery right here. Market retraces into that mitigation block here. Inside of this delivery, there's again a market maker sell model that's present. There's a expansion leg lower, displacement, retrace, continuation. And inside of that fractal, on a higher time frame, you will see those market maker models. Always. So here we can see that origin consolidation, bicep of the curve into that mitigation block low, smart money reversal, boom, there it goes, lower. So here we're going to take a look at the bearish CB scenario. This occurs when there's a lot of bearishness behind the marketplace. It's in a rush to get somewhere. And what you will see is that then when there's a series of consecutive down close candles, that a CB will form. When the market retraces into that CB and it fails to break above it, we anticipate a lower time frame market maker sell model to occur. So that means we're anticipating that this low that got created right here is going to get targeted once the CB gets reached. So that low is our original consolidation. Then the buy side of the curve unfolds into that CB's low, smart money reversal, boom, sell side of the curve. There it goes, targeting this sell side liquidity right here, and eventually lower. Are you noticing how we're moving from a higher time frame fractal to a lower time frame fractal consistently? I know that some of you are probably already like, why is he sharing so many examples? Because I want you to understand this. You need to understand this. Because once you truly see it, repeat over and over again, you will see and you will know. Simple as that. And repetition is key to getting to understand this. So I know that some of you are already like, are these all the point of interest that we can utilize? Is this all there is? Of course there isn't. This is just the most basic version of a point of interest, so to say, from which a market maker model can unfold. We're now going to take a look at something more advanced, which is time-based liquidity. Time-based liquidity is a form of liquidity that is purely based on time, because I am of the opinion that liquidity pools themselves don't mean anything. Simply as that. A liquidity pool is only significant when it formed during the right point or right window of time. Simple as that. And I will explain to you what I mean by that statement. All times that I will discuss from this part on will be in New York time. And just so you note, every time that I will ever discuss within the mentorship is based on New York time. First of all, we're going to take a look at previous month liquidity. So that means if we're now in January, we're going to look at December's high and low. We're going to focus on previous day's liquidity. So that means if we are currently on Tuesday, it means that we're going to focus on Monday's high and low. We're also going to focus on previous session liquidity. So that means if we're now in the New York morning session, we're going to focus on the London session high and low. And finally, if we're currently in a new 90-minute cycle, we're going to focus on the previous 90-minute cycles, their respective highs and lows. You might think, why is this important? Because if you start to see how the market reacts of these very specific price levels during the next time windows, a whole new level of understanding will be unlocked, and you will never look at the markets from the same perspective again. So let me explain to you how we can study this. We're going to take a look at rather simple schematics. We're going to focus on PXH and PX low. X being a variable that can be replaced by whatever time window we're interested in. So if we're swing traders, we're going to focus on higher time frame time windows, of course. We're going to look at, for example, daily highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows, etc. So what we're looking for is when we're bearish, we're going to look for a run on buy side liquidity on the previous X high. From there on, a smart money reversal will occur within a lower time frame sell model, and we will target the PX low. If we're taking a look at the buy model, which occurs if we're bullish, we're going to look for the following scenario. We're going to look for a run on sell stops below PXL, and then we're going to look for a smart money reversal to occur here, targeting buy side liquidity above PXH. And here comes the gem for why this works and why it occurs. The reason why this works is because the market is allowed and it's programmed to move at very specific times of a day, times of week, times of month, times of year, even during specific years it's allowed to move aggressively. And in order for those aggressive moves to occur, a lot of liquidity has to be engineered during a previous time window. So that means that during a previous time window, the market will create a sentiment that, for example, a low is in. So if we're taking a look at an intraday example, it would mean that during the previous day's delivery, they will have created or engineered a lot of sell-side liquidity below that previous day low because they want to create the idea, okay, we're now very bullish. What they will do is that they will run on those stops during the next day's delivery, taking out all of those buyers that got in prematurely, purging the sell side liquidity, and then they will reverse it below that previous day low, targeting the previous day high. And it occurs so many times that you would be surprised that if you would go into your charts and you would study this by how many times it has occurred without you even noticing it. It's because you are purely focused on price, you are purely focused on price patterns, whilst you are ignoring the most important part of it all, which is the time aspect. At what time very specific things occur. And that's something that a lot of people just seem to miss. And it's understandable because you need to dig deep. You need to pay attention to details. And unfortunately, many people are lazy. It's as simple as that. So let's take a look at the previous day liquidity example. Previous day liquidity, I'm now just going to rename the X to the day. So previous day liquidity is relevant in the following sense. If we're bearish, we're looking for a run on the previous day high within a sell model. The smart money reversal will occur above the previous day high, then the sell side of the curve will unfold towards previous day low. If bullish, we're looking for a run on the previous day low. Smart money reversal will occur below there. Boom, buy side delivery towards the previous day high within a market maker buy model. Session liquidity. We're now going to take a look at the session liquidity. So it means the previous session high gets taken out. Smart money reversal will occur above there within a sell model, and then the sell side delivery occurs targeting the previous session's low. If bullish, we're going to look for a run on sell stops below the previous session low. Market maker buy model, its SMR smart money reversal will occur from below there. Boom, we're going to target buy side liquidity above the previous session's high. So now we're going to take a look at all the sessions that I deem to be relevant. We're going to first of all begin each day with Asia. Then we're going to focus on the London AM session, New York AM session to be precise, lunch hour, and the PM session. Each one of these sessions has different reference points that it will refer to whilst trading inside that session. And with reference points, I mean relevant liquidity pools. I will now share what liquidity pools are relevant during each session. But before I do that, I will tell you the following. Because we have these sessions on our charts every single day, we must understand that each session refers to the previous session or to the previous sessions. So that means that London refers to Asia. The AM session refers to London and Asia. The lunch session refers to the AM session, London and Asia session. The PM session refers to lunch, AM session, London and Asia. Here we can see the schematic more in depth with more details. As you can see, during the Asia session, there are no significant draws on liquidities that we can target. This doesn't mean that we can't trade Asia. It does mean, however, that Asia has very minor price runs usually. So when we know that, we need to be very nimble if we ever decide to trade Asia. During London, we can refer to the Asia high and low, and we can refer to the previous day's highs and low. During the AM session, we can refer to the London high and low, and the Asia high and low, and the previous day high and low. During lunch, we sit on our hands and we do not really try to refer to anything. However, if you do decide to trade lunch, and that you see that lunch is likely to move aggressively, then what you refer to, or what we refer to, is to all of the previous time windows. But for now, within this schematic, I have just decided to say, okay, for the model that I am teaching you, you will not often trade during lunch. It's as simple as that. There will be a few very rare instances in which you will see the model that I'm teaching you play out during lunch, but lunch trading requires a bit of a, how to say that, a bit of a different touch to the model. It doesn't mean that it doesn't work and that the price patterns that we will eventually utilize don't work during lunch. It just means that the majority of times lunch will not move as clean as if, for example, the AM or PM session would, or London to say the least. So if we're taking a look at the PM session, we can see that we refer to the lunch high and low, the AM high and low, the London high and low, the Asia high and low, the previous day high and low. And are you noticing that there's a hierarchy to the lows or highs that are relevant during the current session? Notice that the most recent session is the most important for the session that we're currently in, but the other sessions before that recent session should also be noted when it comes to what liquidity pools could be targeted. This schematic was first shared within the time PDF that I shared and released within the Ones That Know back in February of 2023. And since then, many knowers, members of the Ones That Know, have experienced light bulb moments when it comes to time and when it comes to deciphering when certain things are allowed to occur and specifically where as well. Because by looking at the markets from this perspective, it doesn't become random anymore, so to say, why the market formed a high or low there during the current session and then reversed. Because we know the reference points, we know what levels are relevant. We know what levels IPTA is locked on, and now combine this logic of previous XH, previous X low, to what was shared during the beginning part of this lecture when it comes to the higher time frame PD race, and trust me, a whole new world will open up for you. And as you might note, I have decided to share sessions and not speak about kill zones. The reason why I've decided to share sessions instead of kill zones is because I'm not a big fan of the use of kill zones anymore. Because I do not look at London Crows as London Crows kill zone. I look at it as the end of the AM session. And that's why you see 5 boxes here, whilst in the time PDF there was 6. So to summarize, you now know what points of interest we can utilize to look for smart money reversals in. You now know in what higher time frame delivery there is a lower time frame market maker model. So it means that you now know that a higher time frame retracement followed by an expansion leg or continuation leg is a lower time frame market maker model. You got introduced to the concept of time-based liquidity, and you now know the importance of PXH and PXL, and even more important to that is the following, is their relationship to higher time frame PD arrays. The moment a smart money reversal is confirmed, we target opposing arrays and liquidity pools. So that means that if we're in a market maker buy model, the moment that the smart money reversal is confirmed right here, we target buy side liquidity above all highs on the left side of the curve, and more specifically the original consolidation. As a beginner, as someone who is new or who has just started to learn about market maker models, what you can do is that you can draw a range with your Fibonacci tool from this high right here, the high of the original consolidation, to the low of the smart money reversal, measure where 50% is at, where the range midpoint is at, and try to target that. Simple as that. If you can consistently target that, you can then say, okay, let me now try and target the full market maker model, so targeting the original consolidation. You grow into that. You will not go out there after learning, after studying, after investigating, and just be able to say, okay, I'm now going to target original consolidation within every market maker model, because that requires experience that you simply do not have yet, looking at the markets from this perspective. So within a sell model, it's exactly the same, but then inverted. What we can see is the following. We see buy side of the curve into our point of interest, smart money reversal. When that's confirmed, we look to get short inside of a retracement leg, and then we target range midpoint, 50% of the range from this low to high, and eventually the original consolidation. So your homework for this lecture is the following. I want you to collect 30 plus examples in total of the market reversing if it's bearish above the PXH, and the market reversing if bullish below PXL. And now comes something that's important for you to note. Go on the time frame that you are interested in learning how to trade on. If you are interested in learning how to trade like me on the lower time frames throughout the day, so very specifically during the AM or PM session, then what you will do is that you will go into the lower time frames, meaning for example a 1 minute chart, and you will go out there and you will just study how price is reacting to the previous session's liquidity. And after we have shared the importance of time during the upcoming lectures, you will then be able to utilize 90-minute cycles as well for your studies on these time frames during these time windows. If you are interested in learning how to swing trade or hold positions for a longer period of time, you will be looking specifically at previous week's liquidity, or previous month's liquidity, or previous year's liquidity, etc. And you will study how price reacts off those liquidity pools. And note that this all occurs within one-sided institutional order flow on a higher time frame. And every run lower if bullish is considered manipulation, and every run higher if bearish above a PXH is considered manipulation as well. The next lecture will be on time and how we can actively use it. I want to thank you for watching this lecture, and I look forward to speaking to you in the next one. Hello there. Welcome to the third lecture of the day trading model. This lecture is going to be about time. Before we start this lecture, I must first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and or entertainment purposes only. If you want to read the full risk disclaimer that you have agreed upon when subscribing to the mentorship or joining the ones that know, you need to go to our website and you will be able to read it there. Before you watch this lecture, I must share something with you, and that's the following. You need to know how to determine the order flow. If you do not know how to determine order flow, this lecture will do you no good because it's above your current level of understanding. Next to that, you need to know how to determine the draw on liquidity. Again, if you do not know how to determine the draw on liquidity, this lecture will again be of no benefit to you just yet. You need to know how a true market maker model functions and its characteristics, because again, if you do not understand the full inners and outers of the market maker models, this lecture will do you no good, because time is by far the most advanced concept to even discuss, but also to learn about. This is not me saying to you don't watch this lecture. Of course, you should definitely watch it, but first make sure that you have these three things noted correctly within your notes and that you have studied them at least and that you have followed on through the homework assignments that have been provided to you during the past two lectures. This is me as a mentor guiding you in the best manner possible, and this is not me saying, okay, don't watch this. This is just me giving you reasonable advice and saying, okay, you should first do this, and then when you understand that, come here. So let us take a look at the table of contents for this lecture. This lecture is going to be the longest lecture by far so far of the model series. The reason why this will be the longest lecture is because, again, time is the most advanced concept that you can discuss. And therefore, I want to go in great detail with you with sharing how I interpret time and utilize it within my own trading. So first of all, we're going to take a look at the sessions of interest. These sessions are the following. First of all, we're going to take a look at the London session and the characteristics that are present during London. After that, we're going to take a look at the morning session. And finally, we're going to take a look at the afternoon session. As you may notice, we're not going to look at the Asia session because in my opinion, Asia is not a great session to trade. So let's begin with the sessions of interest. For Forex, so for trading, for example, Euro or GU, your focus should be on the London and morning session. The afternoon session can be skipped for Forex. The reason why this is my advice is because the London and morning session usually provide the most volatility for the main markets of interest, and therefore I would always look for setups in Forex during the London and morning session. For the index futures, I would focus on the London, morning, and afternoon session. However, here comes something very important. Please do not try and trade every session. You should pick the session or sessions that suit you best and let go of the others. If you notice that, for example, the London session fits best in your daily schedule, due to, for example, work or due to a personal life, etc., then your focus should just be on the London session and you should ignore the morning and afternoon session. If due to your personal routine, the morning session fits you best, focus on the morning session and let go of the London and afternoon session. If, for example, the afternoon session fits your schedule best, focus on the afternoon session and let go of the London and morning session. If you want to take it a step further and you are full-time, then I would suggest every single index futures trader to look both at the morning session and the afternoon session. During this lecture, I will share very specific time windows during which we will be looking at the morning and or afternoon session. We will not be stuck to our charts all day because that's not effective trading. Effective trading is the following. You know when and where you're looking for very specific things to occur. You're not looking for, oh, I see a breaker setup, therefore I'm going to trade this breaker setup. No, that breaker setup will only be valid during the right period of time at the right point of interest. And that's where I'm trying to guide you towards. Here we can see the sessions and their time-based draws on liquidities. As we can see, during the Asia session there are no significant draws on liquidity. During the London session, our eye is drawn to the Asia high and low and to the previous day high and low. During the AM session, our eye is drawn to the London high and low, to the Asia high and low, and to the previous day high and low. During lunch, we usually sit on our hands, and during the PM session, our focus is drawn to the lunch high and low, to the AM high and low, to the London high and low, to the Asia high and low, and to the previous day high and low. As you may notice, there are 5 boxes, 5 significant time windows that I look at. The reason why there are 5 significant time windows has to do with the following. I try to look at sessions purely, but within the sessions themselves, I divide the sessions into 3 parts, and that's something that we will discuss during today's lecture more in depth, why I like to do that. Before we begin with looking at the sessions, I must first share an important note with you, and that's the following. We will discuss delivery profiles. Each scenario has its own characteristics. Our job is to determine what scenario is likely to occur. This does not mean that every single day there will be a profile that we would be able to engage in, and that's okay, because not every single day is a trading day. Later on, within the model series, we will discuss environment selection more, and then we can basically already see when those profiles that we will discuss today will likely occur and when not. And the days on which they are likely to occur, we need to, of course, be present. That's when our shop is open. That's when we allow customers, which are setups, to enter the store, and we can either treat them in the right way or we can let go of them and just ignore them and don't service them. These delivery profiles do not occur every single day, and therefore you cannot force their occurrence. You need to wait and see whether or not the signatures that we'll be discussing today are present on the day that you're looking at if you are looking for setups to form. So let us take a look at the scenarios within the London session. First of all, the main question that we will be asking ourselves if we take a look at London is the following. What has Asia done? The first model that we will be discussing in a bit is the Asia High, Purge and Revert model. After that, we will take a look at the previous day High, Purge and Revert model. Then we will discuss the Asia Expansion model for shorts. Then we will take a look at the Asia Low, Purge and Revert model. After that, we will take a look at the previous day low, purge and revert model. And then finally, we will take a look at the Asia expansion model for longs. So let's take a look at the Asia high, purge and revert model. For the Asia high, purge and revert model, we will be looking at the following. We will be looking at, first of all, a market that is predetermined to go lower. So from the higher time frames, we have established that the market is likely to draw lower towards a sell set objective, a key liquidity pool, or to an old imbalance that price is likely to revisit. When we know that, and we have seen that Asia consolidated, then what we will look for is for a run higher around 2 a.m. towards the Asia high, and above the Asia high, we want to see the signatures occur that we have been discussing during the model series. So for example, the left side of the curve, their respective discount arrays get violated, or a lower time frame breaker setup forms, market structure shift pattern, change in the state of delivery occurs after the Asia high gets purged. During what time? During 2:30 to 4. If no reversal occurs during 2:30 or 4, I would walk away from the London session. From there on, I want to see displacement to the downside occur, and I want to see sell side delivery occur. What would be the first drawn liquidity? The first drawn liquidity would be the Asia low, and secondly, that higher time frame objective that price is likely to draw towards. The second model that we will be looking for during the London session is the previous day high purge and revert model. This model again occurs when the higher time frame order flow is bearish and we're looking for lower prices. What we will be looking for is a run higher to originate from around 2 a.m. and from there on we want to see the market draw towards the previous day high. When the previous day high gets traded above, we will be looking for signs to confirm a smart money reversal during 2:30 to 4. During this time window, we want to see a high form above the previous day high, and we want to see a change in the state of delivery occur on the lower time frames. From there on, we want to see displacement lower occur, which confirms that sell side delivery is likely to be next. This is a rather simple model that can be spotted quite easily when we take a look at previous day highs and how London trades above them. This scenario sets up a classic sell day in which London creates the high of the day, it expands lower, AM retraces and then continues the London trend towards that higher time frame objective. The next model that we will be looking at is the Asia expansion model for shorts. This model sets up when Asia is an expansion leg lower, so that means during the Asia session we saw speed and velocity to the downside. Then from the midnight opening or around the midnight opening, we want to see a retracement occur into an imbalance that formed during the Asia session. This run higher traps retail buyers into believing that higher prices are likely to be next during the London session. The market reprices into that inefficiency. A lower time frame market makers sell models smart money reversal forms inside of that CB. And from there on, we want to see sell side delivery occur. This model again occurs when the higher time frame order flow is bearish and price is drawn to a higher time frame sell side or inefficiency objective. This retracement leg usually forms the high of the day for the market to then continue lower, and this model occurs within fast markets. Again, we want to see the high form between 2:30 to 4 a.m. The next few models that we will be looking at for the London session are the same models but then for longs. So what we're going to look for is for a Asia low purge and revert model, in which we want to see that Asia has engineered liquidity on both sides of the marketplace. And from there on, we want to see that around 2 a.m. a manipulation run lower occurs, purging the sell side liquidity below the Asia low. A smart money reversal forms here during 2:30 to 4. And from there on, we want to see that market shows a willingness to trade back above the Asia low and show lower time frame change in the state of delivery signatures to continue price higher towards the Asia high. This model sets up when the higher time frame order flow is bullish and the market is drawn towards buy side liquidity or to an all-in efficiency. You might be wondering, Zeus, why are you putting emphasis on around the 2 a.m. window? Because around 2 a.m. you will usually see a volatility injection during the London session. That volatility injection can be utilized for manipulation purposes. If there is a news event during the London session at a specific time, that news event is release could also be utilized for that final manipulation leg towards the point of interest, which is the Asia low, from which a smart morning reversal can occur to reprice higher. Now we're going to take a look at the previous day low, purge and revert model, where we see that around 2 a.m. a manipulation leg begins, market draws towards the previous day low. The moment that the previous day low gets purged during 2:30 to 4, we're looking for signs of a smart money reversal occurring below that low, and from there on we want to see price trade back above the previous day low to confirm a lower time frame change in the state of delivery, and from there on we want to see a buy program unfold towards the previous day high if the higher time frame order flow is bullish. The next model will be that Asia expansion model, but now through longs. This model occurs when we see an expansion leg during the Asia session. We want to see a manipulation leg lower originate from the midnight opening, and then we want to see price trade into a imbalance that formed during Asia in a discount during 2:30 to 4 a.m., where we will be looking for a lower time frame smart money reversal to occur from to target buy side liquidity next. The buy side liquidity that we will be targeting is above, first of all, this high and the buy side liquidity that was engineered in the past where the market is drawing towards. This retracement into that Asia imbalance usually sets up the low of the day, and this occurs during very bullish market environments, and this is the first step to seeing whether or not a classic buy day is likely to unfold, where London forms the low of the day, and we can then look for buys during the AM session as well if the higher time frame objective has not been met just yet. What's important to note is that what I shared with you so far with regards to the London session is rather simple. It's rather basic when it comes to determining point of interest and what to look out for. And the reason why I'm keeping it simple for the London session is because of the following. London has a characteristic where if you are looking at index futures, its respective 90-minute cycles delivery are not that clean compared to the AM and PM session. If you are looking at London for example, EU or GU, then you will notice that what you will be able to do is that when you have established that a higher time frame POI is, for example, a BC that forms during Asia, you will notice that during the first 90-minute cycles of London, which is 2:30 to 4, you will see that if you fractalize that 90-minute cycle to 30-minute windows, where you have 2:30 to 3, 3 to 3:30, 3:30 to 4, you will notice that if 2:30 to 3 doesn't yet trade into that imbalance, 3 to 3:30 will form the low, and from there on 3:30 to 4 will confirm the smart money reversal. This is something for you to look into, and when we discuss the 90-minute cycles more in depth during the AM session in a bit, it will be more clear to you to how to apply this logic. So to finalize the schematic that we've been discussing so far during the past few lectures, we have the following schematic, where if we are bullish, we are looking for the following. We are looking for sell side delivery to occur into a point of interest, into a discount array or a PXL, for example, previous session low, specifically the Asia session low or the previous day low, during 2:30 to 4. And from there on, we want to see buy side delivery next if the higher time frame order flow is bullish. It's important to note that time cycles, they shift. So that means that you should be flexible when it comes to, for example, saying, okay, I want to see it specifically occur during 2:30 to 3 or 3 to 3:30. That's why I've given you a 90-minute window to look out for. When we take a look at the bearish example, we are looking at the following. We're looking for repricing higher into a point of interest, into a premium ray and PXH during 2:30 to 4 a.m. Again, this occurs when the higher time frame order flow is bearish, and we want to see a smart money reversal occur within that point of interest during the right time, and then we want to see sell side delivery occur next. So to summarize, here are the times of interest for the London session. During 2:30 to 4 a.m., I want to see a smart money reversal form. If no reversal is present during this time window, I will walk away from the London session. I need to see an expansion leg during 3:30 to 4 a.m. towards the targets. If, for example, the smart money reversal occurs at 2:45 a.m., I don't anticipate the market to go sideways until 3:30 a.m. I want to see it begin to expand from at least 3 a.m. on. So that was the London session. My focus as a trader is mainly on the AM and PM session, so it's time to go deep into time during those sessions. First of all, we're going to begin with the regular trading hours. The regular trading hours are from 9:30 to 4 p.m. Often a gap will form between the closing price of the previous day and the opening of the new day. This is called the regular trading hours gap, or the RTH gap. Price will seek to reprice back into this gap to rebalance it before expanding. This information is useful because if we know that there's an RTH gap present, then we can anticipate price to trade back into that gap or reprice into that gap to rebalance that inefficiency before expanding and continuing the real order flow. So let us begin with the 9:30 opening. The 9:30 opening is for me the most important opening price of the whole day. The reason why this is the most important price for me is because this is the open or the beginning of the regular trading hours. And we will always see a volatility injection during the 9:30 time window. If we take a look at why we are looking at the 9:30 opening specifically, we will be looking for the following. If we are bullish, we want to buy below or in close proximity to the 9:30 opening price. If we're bearish, we want to sell above or in close proximity to the 9:30 opening price. The 9:30 opening price is, in my opinion, the most important reference point that we can have on our charts throughout the whole trading day during the regular trading hours. Before the 9:30 opening, we can of course trade. There are still algorithmic signatures present. However, the 9:30 opening is a very important confluence for me when it comes to determining high probability setups. If we are looking at how 9:30 can deliver, we can look at the following. We will be looking at 9:30 opening profiles. It's important to note that these profiles are again scenarios that could occur. If they do not show signs of occurring on the day, I will walk away. We ideally want to see 9:30 create a false run against our narrative, against our analysis on where the market is likely to draw towards, and form a smart money reversal afterwards. This false run engineers liquidity and traps traders that fell for that manipulation. So this is what it looks like. On the left side, we can see what occurs if we're bullish. We can see that the market is trading lower, and then pre-9:30 a low gets engineered right here, and from the 9:30 opening the market completely rips lower. This repricing lower is the final manipulation leg before buy-side delivery comes next. The reason why this is so important is because every retail-minded trader will look at this manipulation leg lower and they will think to themselves, well, We have seen a 9:30 opening that was so bearish, therefore today is likely to be a bearish day. They are purely looking at this, they are not looking at narrative, they are not looking at where's the market like to draw towards, they are simply looking at the price pattern that forms here for them. People that buy or sell on a breakout will sell below this low, and what do? We buy those sell stops. And from there on, we see buy side delivery occur next because the higher time frame order flow is bullish. For the bearish example, we can see the following. We can see that pre 9:30 a high gets formed right here. Market then retraces. During 9:30, a run on the buy side liquidity above that high originates. And we can see that after that high gets purged, a higher high forms and the market begins the real sell side delivery program. Again, the reason why it secures is because of the following. From the 9:30 opening, they will reprice it higher and people will chase that. They will buy that because they see big green candles on that charts. Especially when those people are purely looking at the 9 or at the regular trading hours. So the 9:30 opening is the first time that a candle begins to print on their charts. And you would be surprised how many people just look at irregular trading hours. So what they see is that from here on, they see opco candles, opco candles, opco candles, opco candles, opco candles, and then out of nowhere it begins to turn. They are surprised why that happens, but they are already in their long position. And if they do not cut their trade when the market shows that it's forming a high here, they will get stopped out, or they will not even get stopped out and their account will be blown. We do not care about what those people do because we are purely focused on ourselves. When we look at this, we need to recognize that there are people that are making that mistake, and that's our enemy, that's our target, that's the opposing liquidity on our trades. So when we see that manipulation run higher towards the high that formed pre 9:30 into our point of interest, because that's important to note. Our point of interest is here, and for the buy model, our point of interest is here. When we see that occur, we will be ruthless and we will wait for our signatures to confirm that this is the high, and from there on sell side delivery is likely to be next towards our higher time frame draw on the liquidity. This is what the manipulation looks like within the buy model, and this is what the manipulation looks like within the sell model. The gray boxes represent this. Another 9:30 opening profile is the following. If 9:30 trades in our anticipated direction, we want to see a fake high or low form and then rip against our direction. This will be a false move before the real smart money reversal forms. Let me show you a schematic to explain what I mean by this description. This false run engineers liquidity again. What we see is the following. We are bullish on the marketplace. From 9:30 on, we see that the market rips higher and it forms a high. Again, what does every retail minded trader think when they see that? They want to buy that market. And what occurs afterwards is that sell side delivery occurs and the market gets repriced below the sell side liquidity that was engineered from the 9:30 opening. Why was sell side liquidity engineered? Remember everyone that was purely looking at the regular trading hours and tried to buy this from the 9:30 opening? They placed a stop below that opening price. So the market purchases that sell side liquidity, forms the smart money reversal inside of a point of interest, and from there on the real delivery occurs towards higher prices. For the bearish example, it looks like this. We see that the market trades higher. From 9:30 it begins to rip lower. Everyone goes short. What does the market do? Or what occurs? It gets repriced higher, purging the buy side liquidity that got engineered above this high, and then the real move occurs. Again, what I want you to note is how I'm looking at manipulation from that very specific time. That's so important to understand and note. This is what the manipulation looks like. If bullish, this whole leg higher is the manipulation leg. And if bearish, this is the whole manipulation leg from the 9:30 opening. But you could even argue that the real manipulation is everything above the opening price, and that's a valid argument as well. But what I'm showcasing here to you is that multiple manipulation legs follow after another. If you truly believe that the market is driven by algorithms, looking at the markets from this perspective will make every single market move logical to you, and you would never be surprised anymore why the market did what it did. Because if you look close enough, you will always see the logic that I'm sharing here with you occur, no matter what. This does not mean that you will be profitable trading these concepts. I cannot guarantee you profitability. I am purely sharing with you my own opinions on the marketplace. And again, this is in accordance with the terms of services and the risk disclaimer that you have agreed upon when joining my mentorship and subscribing to the platform. So the smart money reversal occurs below that 9:30 opening price, and this orange box represents that if bullish, and if bearish, this orange box represents the smart money reversal within that sell model. We'll now be looking at the morning session scenarios. First of all, the main question that we will ask ourselves is the following. What have Asia and London done thus far throughout the trading day? The first model that we will be looking at is a London high purge and revert model. Secondly, we will be looking at the Asia high purge and revert model. And thirdly, we will be looking at the previous day high purge and revert model. We will also be looking at the London low purge and revert model. We will be looking at the Asia low purge and revert model. And we will be looking at the previous day low purge and revert model. And finally, we will be looking at the London expansion models. So first of all, we're going to take a look at the London high purge and revert model. This model occurs when we have seen that the London was going sideways or was consolidating, I should say. We then see that the market begins to trade higher. We want to see that around 8:30 a.m. a leg higher begins, a run higher. 8:30 is a very important opening time during the AM session, and we will discuss in a bit why this is an important opening time. It is also an important opening time, by the way, because a lot of high impact news usually originates or gets released around 8:30. What we want to see is that the market begins to trade higher into that buy side liquidity above the London high. We want to see that price level gets traded above during 9:30 to 10:30. For the viewers that are paying attention, they will notice that for the AM session, we have 1 hour for our point of interest to be reached, whilst for the London session, we had 90 minutes. And that's what I mean with saying that AM and PM are more precise time-wise than the London session when it comes specifically to the index futures. So between this time window, we want to see the market trade above the previous day high, and we want to see a smart money reversal occur from there. We then want to see displacement to the downside, and from there on we want to see sell side delivery occur next. This model occurs when the higher time frame order flow is bearish and the market is drawn to a key sell side objective or old inefficiency. The next model that we will be looking at is the Asia high purge and revert model. This model occurs when Asia was a consolidation, London was an expansion away from that original consolidation, and we see that around 8:30 a run higher begins towards that Asia high. This run higher is the buy side of the curve within a market maker sell model. We want to see the market trade above that Asia high during 9:30 to 10:30, and we then want to see signs of a smart money reversal originate from there. From there on, we want to see displacement to the downside, and from there on, we can anticipate that the market will draw towards the London low and the higher time frame sell side objective and inefficiency if the higher time frame order flow is bearish. And it's important to note that everything lies around determining drawing liquidity and knowing the higher time frame order flow. And that's why I shared with you that if you did not understand those topics just yet, this lecture should not be watched. Because unless you understand those things, these delivery profiles will not do you any good so far. So let us take a look at the next schematic. The next schematic is a previous day high purge and revert model. This model occurs when we see that Asia was a consolidation, London takes out both sides of Asia, and we then see that around 8:30 the market begins to reprice higher towards previous day high. We want to see this high get reached during 9:30 to 10:30, and we want to see a smart money reversal occur above that previous day high, and we want to see signs of a change in state of delivery occurring to target sell side liquidity below the London low and below all of the other significant sell side pool liquidity pools. This model is fairly straightforward, just like the others. We're now going to take a look at the London expansion model for shorts. This model occurs when we are in a very bearish market and the market is drawn to a key sell side objective. We then see a expansion leg during London, which leaves behind an inefficiency, a CB to be precise. Around 8:30, we want to see a retracement occur into that CB, and between 9:30 to 10:30, we want to see that CB get reached, and from there on, we want to see a lower time frame market maker sell model get confirmed to target the sell side liquidity below this low and draw towards the higher time frame objective. Let us now take a look at the bullish examples. First of all, we're going to take a look at the London low purge and revert model. We want to see that around 8:30 the market begins to reprice lower into the London low, and we want to see a smart money reversal occur below that London low between 9:30 to 10:30. When the market then displaces to the upside and trades back above the London low, we will see our bullish breaker formation here, and we can then anticipate higher prices to be next if the higher time frame order flow is bullish and the market is drawn to buy side liquidity or an old inefficiency, especially in the form of a CB. If we're taking a look at the Asia low purge and revert model, it looks like the following. Asia was consolidation, London expanded to the upside, but did not continue higher. Instead, the market retraced lower, and from 8:30 we want to see sell side delivery occur. We want to see manipulation to the downside occur. Where could the market potentially reverse? Below the Asia low. We want to see the Asia low get reached between 9:30 to 10:30, and we will be looking for signs of a smart money reversal occurring below there during that time window. And if we see that order flow is shifting bullish intraday, we will first be targeting the London high, and after that the higher time frame objective that we are targeting. And then another model is the previous day low purge and revert model, where Asia was consolidation, London took out both sides of Asia, and then we see that around 8:30 the market begins to sell off again. Into what? Into the previous day low, and then between 9:30 to 10:30 we want to see that previous day low gets taken. We want to see a purge of that occur, and we want to see displacement to the upside occur. When that displacement occurs and we have taken out the sell side liquidity, we want to see the market draw towards the buy side liquidity above the London high and the liquidity resting higher. And the final model for longs during the AM session is the London expansion model, where we see an expansion leg during London that leaves behind an imbalance. Then between 8:30 to 10, yep, 8:30 to 10 specifically, we want to see a retracement occur. We will discuss this soon. Why? But we want to see that BC gets reached between 9:30 to 10:30. We want to see a low time frame smart money reversal occur, and we will be targeting buy-side liquidity resting above this high and higher. This model again occurs when we are in a fairly bullish market and the market is in close proximity to the higher time frame objective. So let us divide the morning session in 90 minutes now. First of all, 7 to 8:30 is the accumulation phase. This is the first 90-minute cycle of the morning session. This cycle is referred to as AM1, the first cycle of the AM session. The second cycle is 8:30 to 10. This is the manipulation cycle. This cycle is referred to as AM2. The third cycle is 10 to 11:30. This is the distribution cycle. This cycle is referred to as AM3. So what we have is that we have accumulation, manipulation, distribution. 7 to 11:30 AM is my AM session. That's how I look at the AM session. And we will now take a look at this AM session through the lens of these 90 minutes. We will now look at the AM session through the lens of 90 minutes. First of all, we are looking at the following scenario, in which a purge of the first AM cycle's high, AM1H, and referred model occurs. The second model will be a purge of the second AM cycle's high and a referred model. The third scenario will be a purge of both the AM cycle 1 as the AM cycle 2 highs and referred model. We will then be looking at the purge of the AM cycles 1 low and referred model, and we will then be looking at a purge of the AM cycle 2 low and referred model, and finally we will be looking at a purge of the AM cycle 1 and AM cycle 2 their lows and referred model. It doesn't take long if you start putting in the work in your own charts after getting introduced to this theory to see the validity behind this theory. So let us take a look at the schematics. The first scenario is a purge of the AM cycles 1, his respective high, and a referred model. The AM cycle 1 is between 7 to 8:30. This is the accumulation phase of the AM session. We can see that the market is consolidating. Buy-side liquidity is being engineered above those highs. Then during the second 90-minute cycle, between 8:30 to 10, we can see that the market trades above that previous cycle's high and it reverts lower. It displaces to the downside. Then between 10 to 11:30, the market distributes quickly lower. What is occurring right here inside of this consolidation? Inside of this consolidation, orders are being accumulated. That means that smart money that have very deep pockets, that have a lot of money, they accumulate shorts here. They then manipulate higher to short once more to trap buyers, to trap retail buyers to be precise, into believing that the market is going to go higher. They buy this on a breakout and they try to capture a run higher, whilst smart money is opening more shorts here. This is the manipulation phase. And then distribution occurs and the market begins to sell off because the higher time frame order flow is bearish. So to summarize this scenario, we see a run on the high that forms between 7 to 8:30 during 8:30 to 10, and this sets up the highest price of the AM session, of the morning session, and then the market begins to fall and it distributes going into lunch at 11:30. The second model is the following. This is a model in which, or a scenario slash profile, in which there's a purge of the AM too high and a revert occurs. This occurs when the accumulation cycle has went sideways, the manipulation cycle took out the previous cycle's high, so the high of the accumulation cycle, but it did not displace to the downside yet. Why not? Because usually there is a high impact news driver at 10 a.m. that will be used for repricing and manipulation purposes. So what they do is they hold the markets sideways or going sideways between 8:30 to 10, and then at 10 a.m. that high impact news driver gets utilized to send price higher once more, trapping buyers into believing that it's gonna go higher. Buys and liquidity gets taken out here. Smart money sells short against that, and the market begins to roll over quickly during the distribution 90-minute cycle between 10 to 11:30. And then finally, the third scenario that we will be looking at is a purge of both the AM1 high as the AM2 high and revert model. So what we are seeing is the following. We are seeing that both the accumulation cycle